Hi, I'm Saul Simon, and welcome to Simon Says Manage Your Money. Very exciting show today called Forgotten Equity, and I'm proud to introduce a friend of mine, Dave Muti from Forgotten Equity. Welcome to the program.
Thank you, Saul.
Today we're going to be discussing some thoughts about the concept of forgotten equity, discussing retirement, and looking to discover ways of being able to accumulate additional wealth for you and your family to make retirement a little easier. Statistically, people are telling us how much money we need to have available for the future, and if you've done some planning on your own, you may be realizing that you're falling short, or you need to get higher rates of return, or you need to be working longer. And given what's happened in the market over the past few years, many people have concerns about entering back into the market or have those fears. So why don't we start the conversation with Dave and just basically ask the question, what is forgotten equity?
Sure. We kind of touched on a basis that most homeowners out there, everyone today goes to the market that were house rich and cash poor. And we've realized that people have all this money sitting in their homes, and homes aren't made to house money, they're really made to house people. So what we show people is that equity really does not have a rate of return. They have a significant size of money sitting there that if we show them how to reposition that into guaranteed investments towards retirement planning, we can actually do much better in the long run for the client from retirement planning and investment standpoint.
So you and I have had many conversations about this. We've also gone to different programs and courses to understand certain distinctions or principles, and some very smart economists and financial advisors who share different methods or strategies of how we originally used to plan for retirement. So why don't we go over some of those thoughts and share it with the public? And I'm sure people on a national basis will be hearing and looking at this program so that they can look to the website that you'll offer and let them look at some of the tools that are available so they could see and realize some of the equity that they have in their home truthfully is not earning anything.
Sure. Well, let me retract and back to the equity standpoint that there's a misconception out there from everyone I talk to, both in the financial planning arena, the financial advisors, as well as consumers and my clients locally here in New Jersey. But people assume that when they have money in their house, it's earning them a rate of return. But we show clients actually there's a 0% rate of return on your home equity. It's as if you took cash and buried it in your mattress. It's not going to do anything for you. Same thing while it's sitting in your house.
Expand on that for a second, please.
Sure. If you and I are neighbors
Yes.
in a development, we have cookie-cutter houses. And let's assume that your house is worth $300,000 and my house is also worth $300,000.
Right.
Let's assume we both bought at the same time, and you decided under the old school of thinking, I want to put down as much as I can put down so I have a smaller mortgage, and therefore my monthly expenses will be lower. I've subscribed to the newer theories that we want to put as little money down and have my money go to work for me elsewhere.
Leverage.
Leverage, correct. So what we'll do is you take out a $100,000 mortgage, put $200,000 cash down on your house, where I'll take out a $300,000 mortgage. And I'll take my $200,000 cash and I'm going to put it somewhere else. Let's fast forward now 10 years. Let's make math simple. Assume we had a 10% appreciation on our homes. So now, 10 years from today, well, lo and behold, your house is worth $330,000. You had an original $100,000 mortgage. My house is also worth $330,000. My $200,000 extra money was off on a side account, earning me interest as well.
Right.
So we show and we illustrate some of these tools on our website that equity really does not have a rate of return. And if we can reposition that money into a guaranteed side fund, you'll do much better off over the long run.
So first, ladies and gentlemen, what we want to ask you to do is take out a piece of paper and a pen or a pencil and start taking some notes, because some of the distinctions that we were taught from our parents, and the distinction is our parents grew up in the Depression era. So they wanted to have their house paid off. They wanted to have a mortgage burning party. But some of the distinctions that Dave will be going over and we will be discussing is actually a whole 180-degree turn as to refinancing or getting a mortgage on your home, because we were all taught to get a 30-year fixed interest mortgage and be able to have that paid up. And some of the things that I've learned in reading and some of the things Dave's taught me is the longer you're into this mortgage note, the less you're paying in interest, and interest is a deductible expense, and the more you're paying in principal, which is feeding more money back into the home, which based on Dave's communication, which I agree with, is not earning any type of interest given that this equity is in your house and it's locked up.
Let me put it to you this way. There's an expression, when you're paying down a 30-year fixed mortgage or a 15-year fix or what we call as an amortized loan, every month you're paying part of interest and you're paying partially in principal.
Right.
Let's kind of make a kind of a crazy analogy on that or draw out what that's actually happening. Every month you're paying $300 to the bank, $500 to the bank as part of your principal payment. If you're subscribing to the theories of pay your mortgage down quicker, it might be more than that.
That's right.
So every month you're going out and you're reaching your checkbook and you're talking to the banker and you say, Mr. Banker, please take my $500 check from me. It's my money towards my principal. You keep it. You do what you want with it. Don't pay me for it. And then you can loan it out. You can make money on it. Now I decide if I want my money back from you, I'm going to fill out your application. I'm going to pay you an application fee. I'm going to pay you interest now to borrow my own money back.
Like a home equity.
Exactly.
Line.
Doesn't seem very prudent and seems kind of foolish when you describe it in that manner.
That's right.
So when you look at doing that, we talk to clients about the world is different today than when our parents and our parents, our grandparents grew up.
Yeah.
We have interest-only products available today. So rather than giving that bank your money, it's not the bank's money.